All right, today we are diving headfirst into the technical chart of one single stock, WTO. Now, why this one? Because it's a fantastic real-world example of a stock in a total tug-of-war with itself, sending out these incredibly strong signals in completely opposite directions. So what we're going to do is deconstruct this puzzle and figure out how analysts even begin to make sense of this kind of chaos. So first things first, let's get our bearings. At its absolute peak within the last year, WTO is trading at $4.40. You know, a solid number. Keep that price in your head. And now, prepare for some serious whiplash. Today, that very same stock is trading for just over 5 cents. Yeah, you heard that right. That isn't a dip, it's not a correction, that's a full-blown collapse. And this gets us to the huge question, the one that frames this entire explainer. After a stock drops 98%, what are you even looking at? Is it a falling knife, something you'd be crazy to try and catch? Or is it a coiled spring, just wound so incredibly tight with selling pressure that it's about to rocket upwards? The chart is telling both stories at once. Let's start with the scary one. Okay, first, you always have to respect the trend. And right now, the evidence for a powerful, relentless downtrend is, well, it's pretty overwhelming. So let's take a look at the anatomy of this thing. Just look at how these moving averages are stacked. Think of these lines as tracking the stock's average price over time. In a healthy stock, the short-term lines are way above the long-term ones. Here, it is the complete opposite. And that 200-day average, that's the big one. It's sitting all the way up at $1.49. The current price is like a tiny little speck on its radar. I mean, this is literally the textbook definition of a deep, sustained downtrend. Now, before I throw the next number at you, you need to understand this tool, the ADX. The ADX doesn't care if a stock is going up or down. All it measures is how strong that trend is. And the rule of thumb is, anything over 25 means you're looking at a really powerful, high-conviction move. And boom, this just hammers the bear case home. WTO's ADX isn't just over 25, it's a massive 48.48. That's a raging, full-force trend. But which way is it raging? Well, that's where you look at the DI lines. The minus DI, which tracks downward pressure, is at 47. The plus DI for upward pressure is barely there at 11. It's not even a contest. The chart is basically screaming at us that this trend is incredibly strong and it is pointed straight down. So with numbers like that, you'd think the case is closed, right? I mean, it looks like an absolute disaster, a huge stay away sign. But, in the world of technical analysis, it is rarely ever that simple. What if all of this brutal negativity has actually created a totally different kind of opportunity? So now let's flip the coin and look at the other side of the argument. We're going hunting for signs of life, those little whispers of a potential reversal that might be buried deep underneath this really ugly trend. To find these whispers, analysts use tools like the RSI. The best way to think of it is like a tension gauge for the stock price. When it drops below 30, it's a signal that the selling has just gotten so extreme, so one-sided, that the stock is now oversold. Think of a rubber band being stretched to its absolute limit. And would you look at how far that rubber band is stretched? The official oversold level is 30. WTO's current RSI is down at 16.65. It's not just oversold, it's deep in extremely oversold territory. Nothing can stay this stretch forever. At some point, basic physics has to take over, and it's probably going to snap back. And here it is. This is the whole conflict on one slide. On one side, you have that powerful, established downtrend backed up by the ADX. But on the other side, you've got these potent reversal signals, an RSI that's just screaming oversold, and as we're about to see, a risk-to-reward ratio that is frankly kind of mind-boggling. Two completely opposite stories being told by the very same chart. So, how on earth do you resolve a conflict like this? Well, what analysts do is they start weighing probabilities. They map out the potential futures. So let's look at the 3 most likely scenarios that could play out from here, based on all this data. And this, right here, is the really fascinating part of the analysis. Despite that absolutely terrifying downtrend we just walked through, the analyst actually assigns a 60% probability to a bullish reversal. Yeah, 60%. The chance of the downtrend continuing is only 25%. Now, why would they do that? Because the conditions have gotten so extreme that a reversion to the mean, that rubber band snapping back, is actually seen as the most likely thing to happen next. Now, these scenarios aren't just random guesses. They're tied to specific battle lines on the chart. The bullish case gets triggered if the price can just break above that ceiling at 5.6 cents. The bears win if it fails there and instead breaks through the floor at 4.7 cents. And that third option, well, it just goes nowhere, trading sideways while the bulls and bears slug it out.
So let's boil all of this down into a final verdict. What's the bottom line here? What's the actual playbook for someone looking at the stock?
This quote from the analysis really says it all. This is not a safe bet, not by a long shot. It is the very definition of high risk. But, and this is the key, because the price has been hammered down so far, the potential reward, if that bullish scenario plays out, is just as high. And here are the only numbers that really matter right now. I mean, everything is happening in this razor-thin range. The battle lines are drawn. You've got support at 4.7 cents and resistance at 5.6 cents. A break of either of those levels is probably going to tell us where this thing is headed next. Now, how you might play this depends entirely on who you are. A short-term trader might look at that incredible risk-reward and say, you know what, I'll take a shot, with a really clear exit plan if that support level breaks. A long-term investor, on the other hand, should probably just ignore all this noise and wait for real concrete proof of a turnaround. We're talking a sustained move above 9 cents before they even think about touching it. And so all of this leaves us with one final thought. The math here points to a nearly unbelievable 125-to-1 risk versus reward setup, but the trend is just awful. This whole situation perfectly captures the core dilemma of trading and investing. At what point does a calculated risk, one that's backed by data showing these extreme conditions, at what point does it stop being a gamble and start being a smart one? That is the question at the very heart of WTO's chart.